The illusion of stability. In the silver market. For much of the past year, silver has occupied an unusual position in the global financial landscape. It has neither participated fully in the dramatic surges seen in certain commodities, nor has it suffered the prolonged declines associated with cyclical industrial metals. Instead, it has remained in a relatively narrow range, exhibiting a form of price behavior that many market participants interpret as stability. To institutional allocators and portfolio managers, this apparent calm is often presented as evidence that the market has found a temporary equilibrium. Silver's dual identity lies at the center of this perception. It is both an industrial input and a financial asset, a characteristic that causes it to be analyzed through two different frameworks simultaneously. On one side, it is consumed by electronics manufacturers, solar panel producers, and a wide range of industrial processes. On the other, it is held by investors as a monetary hedge, a secondary store of value that often moves in relation to gold, real interest rates, and currency expectations. This dual role allows almost any price outcome to be rationalized after the fact. When silver holds steady during periods of economic uncertainty, it is described as being supported by monetary demand. When it fails to rise alongside gold, the explanation shifts to weak industrial activity. In this way, the narrative is always able to accommodate the price, rather than the price being used to test the narrative. The prevailing institutional view at present is that silver is in a phase of controlled volatility. According to this interpretation, the market is neither under acute stress nor in a speculative bubble. Price movements are described as orderly. Liquidity is assumed to be sufficient, and the absence of extreme daily swings is taken as proof that the underlying structure is sound. Research notes and strategy briefings frequently point to moderate inventory levels, predictable futures market behavior, and the lack of visible supply disruptions as reasons to expect continuity rather than rupture. This confidence is reinforced by the way modern markets communicate risk. Volatility indices, options pricing, and correlation models all suggest a system that is, at least on the surface, functioning within expected parameters. From a distance, silver appears to be a well-behaved asset, responsive to macroeconomic data, sensitive to currency movements, and broadly aligned with shifts in industrial sentiment. For large institutions, this creates the impression that any adjustment in price is likely to be gradual and manageable. History, however, suggests that this type of reasoning is often most persuasive shortly before it becomes most dangerous. Financial markets rarely break in ways that are widely anticipated. Instead, they tend to remain calm until a specific threshold is crossed, at which point price adjustments occur not as a sequence of small steps, but as a rapid revaluation. In the case of silver, this pattern has repeated itself across decades. Periods of extended quiet have frequently been followed by sudden, sharp moves that force participants to reassess assumptions they previously considered conservative. To understand why this happens, it is necessary to look beyond the surface behavior of the price and examine the structure of the market itself. The modern silver market is not primarily a market for exchanging metal. It is, to a much greater extent, a market for exchanging claims. Futures contracts, options, and other derivatives represent a volume of transactional activity that dwarfs the amount of physical silver that changes hands. The system functions efficiently as long as most participants are satisfied to settle in cash or roll their positions forward. The appearance of stability is, in this sense, partly a function of behavior rather than of underlying robustness. This structure introduces a specific kind of fragility. When leverage is high and the majority of exposure exists in paper form, price becomes highly sensitive to changes in positioning, margin requirements, and risk tolerance. Under such conditions, the difference between a slow decline and a sudden drop is often not a matter of fundamentals, but of mechanics. A modest shift in expectations can trigger a chain of forced adjustments, each one reinforcing the next. It is also important to recognize that calm markets tend to accumulate risk invisibly. When volatility is low, leverage tends to increase. When price ranges are narrow, strategies that depend on stability become more popular. Over time, this builds a structure in which many participants are positioned in ways that only work if the environment remains unchanged. The system does not signal danger through gradual deterioration. Instead, it stores tension. Silver's recent price behavior fits this pattern uncomfortably well. The absence of dramatic moves has encouraged the belief that the market is balanced. Yet the same absence of movement also implies that positioning is crowded and expectations are aligned. When too many participants share the same assumption about stability, the market becomes vulnerable not to a slow drift, but to a discontinuity. Historical examples make this dynamic clear. Previous sharp declines in silver did not begin with obvious warning signs in the price itself. They began with changes elsewhere, in monetary policy expectations, in funding conditions, or in broader risk appetite. The silver market, heavily financialized and deeply interconnected with other asset classes, responded not as an isolated system, but as part of a larger liquidation process. In such moments, the distinction between orderly and disorderly markets disappears quickly. Liquidity, which seems abundant during normal times, proves to be conditional. Bids are withdrawn, spreads widen, and participants who assumed they could exit positions gradually discover that the market no longer offers that option. The critical point is not that silver must fall or that any specific catalyst is inevitable. The point is that the current appearance of stability should not be mistaken for structural safety. The market's architecture is designed for efficiency under normal conditions, not for resilience under stress. When stress arrives, it tends to express itself through speed rather than through gradualism. The question, therefore, is not whether silver looks calm today. It is whether the mechanisms that determine its price are capable of absorbing a shock without turning a modest adjustment into a rapid decline. To answer that, it is necessary to examine how the silver price is actually constructed, and who, in practice, controls its marginal movements. That structure, and the risks embedded within it, is where the real vulnerability begins to appear. To understand why the silver market is vulnerable to sudden, nonlinear moves, it is necessary to move away from the visible surface of price charts and into the less visible mechanisms that actually determine valuation. In modern financial markets, prices are not discovered primarily through the exchange of physical goods. They are discovered through the continuous negotiation of contracts, most of which will never result in delivery. Silver is no exception. In fact, it is one of the clear examples of a market in which financial structure dominates physical reality. The global reference price for silver is set almost entirely in derivatives markets, particularly in futures exchanges. These venues were originally designed to allow producers and consumers to hedge price risk. Over time, however, they have evolved into centers of speculative and strategic positioning, where the overwhelming majority of volume comes from participants who have no intention of ever touching the underlying metal. The daily turnover in paper silver represents many multiples of annual global mine production. This is not an anomaly. It is the defining characteristic of the system. Under normal conditions, this arrangement is efficient. It allows price to respond quickly to new information and enables large volumes of risk to be transferred at low cost. But it also creates a separation between price and physical constraint. Because most contracts are closed or rolled before delivery, the market can function with a very small base of actual metal supporting a very large pyramid of financial claims. This is where leverage enters the structure in a fundamental way. Each futures contract represents a relatively small amount of capital controlling a much larger notional exposure. When aggregated across the system, this produces a layered architecture in which many different actors are effectively making directional bets on the same underlying price, using borrowed time and borrowed liquidity. As long as volatility remains contained, this leverage is largely invisible. Positions are adjusted, margins are met, and the system appears stable. The stability, however, is conditional. At the center of this architecture sits the clearing system. Clearinghouses are designed to ensure that trades settle even if one side fails. They do this by requiring margin and by adjusting margin requirements when volatility changes. This mechanism is often presented as a source of safety. In practice, it is also one of the main channels through which stress propagates. When volatility rises, margins are increased. When margins are increased, participants must either add capital or reduce positions. If many participants are positioned in similar ways, these adjustments do not occur smoothly. They occur in clusters. Institutional positioning adds another layer of asymmetry to the structure. Large commercial participants, such as producers, refiners, and major financial institutions, tend to use the futures market as part of broader balance sheet strategies. They are not dependent on short-term price moves for survival. Speculative funds, by contrast, often operate under tighter constraints. They are judged on short-term performance, exposed to redemption risk, and sensitive to changes in funding conditions. Retail participants are even more exposed, often using leverage without fully appreciating how quickly the rules of the market can change. This creates a market in which the distribution of risk is highly uneven. In calm periods, this unevenness is not obvious. Everyone is able to transact, and losses and gains appear manageable. In stressed periods, however, the hierarchy becomes clear very quickly. Some participants can wait, others are forced to act. One of the most important but least discussed features of this system is that price moves are often driven not by new information about silver itself, but by changes in the financial environment around it. A rise in interest rates, a strengthening currency, or a shock in an unrelated asset class can all trigger position adjustments in silver, even if nothing has changed in the physical supply-demand balance. Because the market is so heavily financialized, silver becomes a source of liquidity rather than merely an object of valuation. It is sold, not because it is suddenly unattractive, but because it is available. Stress points in this architecture are well known, even if they are rarely emphasized during stable periods. Margin requirements, as already noted, are one. Another is the concentration of positioning. When many funds are aligned on the same side of the trade, the exit becomes narrow. A third is the reliance on continuous liquidity. The system assumes that there will always be enough counterparties willing to take the other side. That assumption holds until it does not. When liquidity begins to thin, the character of the market changes. Small price moves start to produce disproportionate effects. Stop-loss orders are triggered. Risk models, which are often based on recent volatility, begin to demand rapid de-risking. What initially looks like a normal correction starts to acquire a mechanical momentum of its own. It is important to note that none of this requires panic or a dramatic external event. The structure itself is sufficient. A modest increase in volatility can set off margin adjustments. Those adjustments force selling. The selling increases volatility further. The process feeds on itself. From the outside, this can look like a sudden loss of confidence in silver. In reality, it is more accurately described as a sudden tightening of financial constraints. The market is not voting on the long-term value of the metal. It is responding to short-term pressures within its own plumbing. This distinction matters for decision makers. If price declines were primarily driven by changes in fundamentals, they would tend to unfold gradually as new information is absorbed. In a heavily leveraged, derivatives-driven market, declines often unfold according to the needs of the system rather than the logic of the story. The hidden architecture of the silver price is therefore not neutral. It is efficient, but it is also brittle. It works extremely well when conditions are stable and participants are confident. It works very poorly when those conditions shift. The central question is not whether this structure will ever be tested. It is what kinds of events, even relatively ordinary ones, are capable of pushing it from a state of apparent balance into a state of forced adjustment. To answer that, it is necessary to look beyond the market RS internal mechanics and examine the real-world triggers that can turn structural vulnerability into an actual price cascade. Structural vulnerability on its own does not cause markets to move. It merely defines how they will behave once they are pushed. In the case of silver, the architecture described earlier ensures that when pressure arrives, it is likely to express itself through speed and discontinuity rather than through a slow, orderly repricing. The more relevant question, therefore, is not whether the market is fragile, but what kinds of forces are capable of applying that pressure in the first place. One category of such forces originates in the macro-financial environment. Silver, despite its physical uses, trades primarily as a financial asset. Its price is highly sensitive to movements in real interest rates, currency strength, and expectations about monetary policy. When real yields rise, non-yielding assets become relatively less attractive. This is not a matter of opinion or narrative. It is a mechanical reallocation process that occurs across portfolios globally. Even a modest repricing of interest rate expectations can lead to large shifts in positioning, particularly among funds that operate with strict allocation rules and risk budgets. A strengthening reserve currency has a similar effect. Because silver is priced globally in a single unit of account, changes in that unit propagate directly into demand conditions. A stronger currency tightens financial conditions worldwide, increases the local cost of holding commodities for non-domestic buyers, and often coincides with a broader reduction in risk appetite. In such environments, silver does not need its own negative news to come under pressure. It is sold as part of a general contraction in balance sheet exposure. Another set of triggers comes from the industrial side of the equation. While financial flows dominate short-term pricing, the long-term narrative for silver still depends heavily on manufacturing and technology demand. A synchronized slowdown in global production, or even a sharp deceleration in a few key sectors, can alter sentiment quickly. Inventory accumulation, order cancellations, and reduced forward guidance from major consumers tend to appear first in corporate data and only later in headline economic statistics. By the time the broader market recognizes the shift, positioning is often already vulnerable. Industrial metals have a well-established history of falling faster than expectations adjust during downturns. This is not because the underlying use cases disappear overnight, but because financial markets discount future conditions more aggressively than physical markets can respond. When that happens, silver is treated less like a monetary hedge and more like a cyclical input. The narrative changes, and with it, the tolerance for holding large positions. Financial system stress represents a third and particularly potent category of trigger. Modern markets are deeply interconnected, and liquidity is not compartmentalized by asset class. When stress appears in one area, whether in equities, credit, real estate, or currencies, it often forces funds to reduce exposure elsewhere. Silver, because it is liquid and widely held, becomes a convenient source of cash. It is sold not as a judgment on its prospects, but as a means of meeting obligations or reducing overall leverage. This dynamic is especially pronounced during episodes of forced liquidation. When redemptions accelerate or margin calls rise, portfolio managers do not have the luxury of selling only what they would prefer to sell. They sell what they can. In such environments, correlations tend to move toward one, and assets that are normally considered diversifiers begin to fall together. There is also a class of triggers that originates not in the economy, but in the market structure itself. Exchanges periodically adjust margin requirements, sometimes in response to volatility, sometimes in anticipation of it. These changes are often justified as prudential measures, and in isolation they are. In aggregate, however, they can have powerful procyclical effects. Higher margins force participants to either commit more capital or reduce positions. When many are positioned similarly, the path of least resistance is usually reduction. Algorithmic and systematic strategies add another layer to this process. Many of these systems are designed to reduce exposure when volatility rises or when certain price thresholds are crossed. They do not interpret events, they execute rules. When those rules are shared across a large portion of the market, their actions become self-reinforcing. What begins as a modest move can quickly acquire the characteristics of a cascade. It is important to emphasize that none of these triggers need to be extreme. The silver market does not require a global crisis to experience a rapid decline. It requires only a combination of modest shocks and a structure that is already tightly wound. The more stable and range-bound the preceding period has been, the more likely it is that positioning has become one-sided and leverage has increased quietly. In such a context, the distinction between a correction and a break is often visible only in retrospect. At the moment it begins, the process usually looks like a routine adjustment to new information. It becomes something more only when liquidity withdraws and mechanical selling takes over. From the outside, this is often described as a loss of confidence. From the inside, it is more accurately described as a synchronization of constraints. Funding becomes tighter, risk limits are reached, and actions that were optional become mandatory. The final and most uncomfortable implication is that timing is rarely signaled in advance by the silver market itself. The triggers tend to emerge elsewhere, in central bank communication, in bond markets, in corporate earnings, or in some apparently unrelated corner of the financial system. Silver reacts not because it is at the center of the event, but because it is embedded in the same web of leverage and liquidity. The remaining question, then, is not what could cause such a move, but who is most exposed when it happens, and how the consequences are distributed once the process is underway. That distribution and the asymmetry it reveals is where the real cost of a sudden decline becomes visible. Why silver? Because while gold often steals the spotlight, silver's recent moves are telling a fascinating story, one that every investor should be paying attention to. So, grab your coffee, get comfortable, and let's break down what's really happening with silver prices. For the longest time, silver has been seen as gold's little sibling. It's used in industry, it's used in jewelry, but as an investment, it's often lived in the shadow of its yellow counterpart. But here's the thing. That dynamic is starting to shift. We're seeing some major factors coming into play that could fundamentally change silver's trajectory. Let's start with the big one, industrial demand. Unlike gold, over half of all silver mined is used in industrial applications. Think about it. Solar panels, electric vehicles, 5G technology, all of these booming sectors are incredibly silver hungry. As the world pushes towards a greener, more technologically advanced future, the demand for silver isn't just growing, it's accelerating. For example, the average electric vehicle uses significantly more silver than a traditional car. In the solar panel industry, it's one of the biggest consumers of silver, and that's only set to increase as countries ramp up their renewable energy goals. This isn't speculative, it's a fundamental demand driver that provides a solid floor for silver prices. Now, let's talk about the investment side of the equation. This is where things get really interesting. Historically, the gold to silver ratio, that's how many ounces of silver it takes to buy 1 ounce of gold, has been a key indicator for precious metals investors. For a long time, this ratio has been hovering at historically high levels, suggesting that silver is undervalued compared to gold. When this ratio starts to come down, it typically means silver is outperforming gold. And recently, we've started to see that exact movement. Investors are waking up to the fact that silver might be the coiled spring of the precious metals market, with a lot more room to run. But wait, there's more. We can't ignore the macroeconomic picture. We're talking about inflation, interest rates, and geopolitical uncertainty. When people get nervous about the economy or the value of their currency, they often turn to hard assets like precious metals. While gold is the traditional safe haven, silver offers a more affordable entry point for the average person. It's a tangible asset you can hold in your hand, and in times of crisis, that provides a level of security that digital assets just can't match. As central banks around the world continue to navigate a tricky economic landscape, the appeal of both gold and silver as a hedge against uncertainty remains incredibly strong. So, what does all this mean for the future of silver prices? Let's connect the dots. We have surging industrial demand from green energy and tech. We have a historically high gold to silver ratio that suggests silver is undervalued. And we have a global economic environment that makes holding hard assets very attractive. When you put all these pieces together, the case for a significant upward move in silver becomes very compelling. Of course, No one has a crystal ball. Markets are complex and prices can be volatile in the short term. There will always be ups and downs, but the long-term fundamentals for silver are looking stronger than they have in years. It's no longer just about investment demand. It's a story of critical industrial need colliding with monetary value. This dual nature is what makes silver so unique and potentially so explosive. It's an industrial metal with the soul of a monetary asset. As you're building your own financial strategy, it's crucial to look beyond the daily noise and focus on these bigger trends. The story of silver is just getting started, and it's one you'll definitely want to watch. That's all for today's analysis. What are your thoughts on silver? Are you bullish, bearish, or just watching from the sidelines? Let me know down in the comments. I read every single one. If you got some value from this video, please hit that like button and make sure you're subscribed so you do not miss our next deep dive. Thanks for watching, and I'll see you in the next one.